Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and I'm thrilled to be joined today by Strategist Chairman and Chief Investment Strategist Jason Trennert for a brief conversation on markets. Jason, thanks so much for joining us.
Thank you for having me. It's my privilege.
Great. Well, let's jump right in. You recently wrote a piece that I want to talk about being bullish despite three big unknowns in the market, those being inflation, interest rates, and taxes. And I want to return to the inflation question down the road. But given what rates are doing this morning post-Fed meeting, the 10-year Treasury yield nearing a 14-month high around 175, let's start there. You wrote that higher long-term rates don't particularly scare you all because there's nothing more normal than rates and stock prices moving in sync at the start of a new business cycle. Would you care to explain that a bit, and then maybe opine a bit on when rates would start to perk your ears up a bit?
Right, and Ross, I would say that I was channeling Don Rumsfeld on there's known unknowns, unknown unknowns, and there, of course, the unknown unknowns we can't handicap. But in terms of the known unknowns, it's it's inflation, rates, and taxes. As far as rates are concerned, what we're spending a lot of time looking at is the equity risk premium, which is it's the inverse of the PE, but it's the earnings yield on the stock market. And right now that's positive, even versus a 10-year Treasury yield of 175. So it's positive by close to 300 basis points, about 3%. And that's why we're not particularly worried about long-term interest rates. If you compare it to other parts of time where you saw big bull market peaks, the equity risk premium was actually negative. So if you think about March of 2000 as an example, 10-year Treasury yields were 6%, and the Fed had been tightening pretty aggressively. So that's why we think there's room for rates to move higher. Now, I think from a sector point of view, it's clearly had an impact within the internals of the market, particularly on tech, particularly on very long duration stocks where there's not a lot of profits or cash flows right now. And most of the value is in the terminal, what we call the terminal value. I think higher rates are making a difference for those stocks now. But for the market as a whole, I just think that there are other sectors that are going to benefit from the reason why rates are going up, which is the fact that the economy is going to, in our opinion, really boom this year.
Yeah, I think pointing out that key difference is critical to kind of understanding why higher rates, if they're for the right reasons, might not be so scary. I want to jump back. You mentioned the comparison to 2000, which seems to come up a lot because of the big tech. But you noted that the Fed was tightening and the levels of rates were much, much higher. Yesterday, Jerome Powell and the Fed basically, indicated dovishness for the foreseeable future, inflation, transitory or not, unconcerned. So where do you all stand on inflation? And at what point does that start to become a concern? What are you watching on that front?
Well, Ross, that's another great question. I think it really becomes concerning for the market when the Fed starts. Inflation really becomes a concern for the market when the Fed starts aggressively fighting it. And so, while it may be unpleasant, while it may worry us for all of us collectively about what it's going to look like in the future or the ability of the Fed to rein it in at the appropriate time, ultimately, it's not until the Fed really starts fighting it aggressively that it becomes a real problem for the market. And we always remind people it's not the first rate hike that hurts you, it's the last rate hike that usually results in the bear market. And so we're not even, as in Powell's words, again, to kind of paraphrase him, they're not even thinking about increasing rates or decreasing the size of their asset purchases. So I think inflation is going to be higher this year. There's almost no question about it, given the amount of stimulus that's going to be in the system. But the fact that the Fed isn't going to be worrying about it, in my opinion, means that at least for this year, the market can withstand higher rates of inflation. So that's the way we're looking at it. The question will become later on, again, whether the Fed can maintain control, whether they're as precise as they think they are in terms of the time to raise rates and all the rest of it. For the time being, it's game on as far as the Fed is concerned.
Yeah, it's a thin line for sure, but problem for down the road, I suppose. Well, that's a great way to wrap, I think. Let me ask one final question. The title of the piece was bullish despite the unknowns, and you use the phrase game on. So how are you all positioning at a sector level right now for this kind of higher rates, higher growth, potentially higher inflation environment?
Yeah, I can't say it's particularly non-consensus, but we have a very strong bias towards value over growth. And in particular, we're overweight financials, energy, basic materials, and industrials. So we have a very heavy cyclical bias. We're market weight tech on communications. Last year, just as a side note, we were overweight tech and communications and also healthcare and industrials. So we made a very large change, very wholesale change at the end of last year and the beginning of this year to really go much more in a traditional early cycle, heavy cyclical oriented way as far as our sector positioning is concerned. Again, the problem with tech is that it will probably get hurt the most by higher interest rates in the short term. I would imagine there'll be some subtlety within the technology sector as time goes on, which means that there's the very high flyers without any earnings at all that will have real problems, and then there's the tech stocks that have a lot of earnings and a lot of cash flows. They may get hit in the early innings of this, but I have a feeling they'll come back because they're cyclicals themselves.
Great. Well, that makes a ton of sense. And we always appreciate the wisdom and the time. Jason, I want to thank you again for joining us for a few minutes today.
Oh, it's my great pleasure. Thank you.